In the previous video, we updated this number, so let's go ahead and do it one more time. We're going to update these numbers in 3, 2, 1, and there you go. There's the new updated numbers from the previous video. I know I just updated it again in the last video, and the reason why I'm updating this, and instead of waiting until I usually have to make a deposit or something like that, I mentioned in one of my previous videos that now, thanks to you guys, I have 9 successful referrals. And then I woke up yesterday and then my portfolio shot up about $100. And I was like, wait, what happened? Why is this up so much? And if you go here to my cash movements only, we received 9 referral bonuses in the same day on May 19th. We received $90. And then if you go here to my total activity, if you go to my trading, we put that straight back into the portfolio. You can see my $90 purchase here, or $89.79, and these are the 27 stocks that I bought. So just a huge thank you guys so much for those of you that use my referral link. It's been very hard in a time like now with the shutdown, with my hours being cut down, to still make deposits into this portfolio. I want to keep making content for you guys, and those of you that are the 9 that did use my successful referral, thank you guys so much. And any of you that are watching my videos that have not used that link, make sure to use it if you're interested, and you can get started using M1 Finance. But in this video, we're going to be going over the top 4 stocks that I think are the best to buy for the month of June 2020. Now we can see that my portfolio has performed very well over the last couple weeks, ever since we started the portfolio, but we're going to save that for the end. If you're interested in getting an update on my portfolio as well as my dividend income, you can save that for the end of the video and make sure to fast forward to the end and I'll give you an update on that. But the 4 stocks that we're going to be going over in this video in order, the first one that we're going to be going over is ticker symbol ROST, or Ross Stores. The second one that we're going to be going over is ticker symbol SBUX, or Starbucks. The third company that we're going to be going over is ticker symbol AWK, or American Water Works. And then last but not least, the fourth company that we're going to be going over, which is ticker symbol MO, which is Altria Group. So let's go ahead and get started. The first stock that we're going to go over is ROST, Ross Stores. They have a $32.3 billion market cap, about a 20 PE ratio, and a dividend yield of about 1.1. Over the last year, they are down about 6%, and over the last 5 years, they are up 80.09%. And the main thing I wanted to point out with the stock, so in this video, we're going over 4 dividend stocks, and specifically 4 dividend stocks that are growing their dividends, regardless of the economic situation. This is a perfect example of this. As you can see here, in 2015, Ross paid 12 cents a share per dividend, and then they raised it up to 14, and then it went up to 16, to 23, to 26, and now they're all the way up to 29. So even right here, during this recession, just about 2 months ago when the recession was first starting, they still raised their dividend well over 10%. Actually, if I put that in my calculator here, so yeah, if you plug that into your calculator, 29 divided by 26, they've actually raised it 11.53%. So that is an absolute massive raise, especially in a time of an economic recession. And picking up these shares now, this was a $123 stock, $24 stock right before the recession hit. You are now picking this up under $100, and even during its lows during the bottom, this stock was absolutely hammered. It was cut in half, like I said, from about 124 all the way down to 60 bucks, so over half. This is a stock that I really got my idea from this a couple weeks ago. I have several stocks on my radar, on my watch list that I watch, and I wait for certain price points or certain movements in business models that I want to buy them in at a certain price. And with Ross, it had been on my watch list forever. I love the massive dividend growth. One of the only reasons it's not in my portfolio, basically the only reason, is this dividend yield. It is really low. I don't like that. If it were to be 2.5%, it would definitely be a #1 contender, or if not, it would probably already be in my portfolio. That said, me and my girlfriend the other day, we went to Ross. They finally opened up the Ross that was near my local area. It was just down the street from me. And we walked up to Ross, and we had 5 groups, not 5 people, 5 groups of people ahead in line. They had an X amount of number of people that were allowed to go in the store at the same time, and people were literally waiting outside in groups to wait to go into the store. They were having massive sales, and everything that my girlfriend bought was like 60, 70, 80% off. It was insane. She was getting t-shirts for 99 cents and pants for $1.99. It's absolutely crazy. And it was so crowded that when we finally finished out to go to pay for our items, we literally had to get in line in the back of the store. Yes, you heard me right. So when you check out, the cash registers are always obviously at the front of the store where you check out. We had a line that went to the very back wall. So we literally probably had 50, 60, 70 people ahead of us trying to check out. People were buying things so relentlessly. So before this recession, Ross was already a store that was doing very well. They've made a lot of intelligent business moves. They have a great management team. They have excellent dividend and revenue growth. A lot of millennials like using services where they get clothes secondhand once they've been used. They get a significant discount for them. We've seen other stocks like this, like the Real Real, for example, where people get a lot of high-end clothes like Gucci or Rolex watches or Versace or whatever, and then they pick that up at 60, 70% off of where they bought it. Ross is pretty much in the same scenario, and there's also companies like this, like Stitch Fix, for example. Stitch Fix is a company that I'm very bullish on. I think they have a wonderful business model. Basically, people order a monthly service to where they receive clothes, and then they can also fix their clothes for a small fee and then buy them out. But with Ross, the same thing goes for those millennials that like picking up those cheap clothes. And if there's ever a time when Ross would thrive, a recession is the time. Because people don't have as much money, they're losing their jobs, they're getting their hours cut like me, they're not getting as much government aid maybe as they need, whatever the case is. Ross is a perfect scenario when people can pick up those shirts for $1.99, $2.99, instead of going to a Nike store or an Under Armour or Adidas and getting that same shirt or pair of pants for 30, 40, 50 bucks just because of the logo on it. Now, the main thing I wanted to point out with Ross here, this is why it's going to be so safe in a recession, regardless of the sales being increased. We're going to look at the balance sheet here. One of the things that I always like to point out, especially for companies that have really healthy balance sheets, these are the companies that are going to not only make it in a recession, but they're going to thrive in a recession. So as you can see here, first we'll look at the income statement. It has very solid growth over the last 4 years. Its gross profit goes up every single year. And if you see here on the balance sheet, this is the main thing I wanted to show. Its cash and cash equivalents have increased every single year for the last 4 years, and you can see right now it's at 1.3 billion. And then we're going to go to the long-term debt. Now the long-term debt is on a steady decrease from about 400 million to about 312 million. These numbers are in thousands, by the way, for those of you that don't know. So that's actually 312 million, not 312,000. So as you can see here, 312,000 versus 1.3 billion in cash. They could literally pay off their debt and still have 1 billion in cash ready to go. They have almost no debt whatsoever. And so not only are they about to get a huge influx of revenue with people dying to go out and shop from the shutdown, and those that are losing their jobs and need new clothes need to buy them at a cheaper price, they'll be fleeing to Ross. Ross is going to be the place that they go. But even if I'm wrong, even if they have a huge downturn in sales, if they have lower profits, they have horrible management decisions, whatever, they have almost no debt, and they have a huge stockpile of cash. A cash of 1.3 billion for a company that has a market cap of 3 billion, that's pretty substantial. That's a pretty decent amount of cash, especially for a clothing discount store. So Ross is definitely one that's on my radar, and I think if you guys are interested in a very safe, stable, high dividend growth stock, this is the stock that you want to go with. Ross is very similar to what I would compare it to as a Costco right now. Their business model is thriving. They have a low dividend yield with high growth, and I think it's a very safe and stable stock to invest in. But the second stock that we're going to be going over is Starbucks Corporation. Now, those of you that don't know, I just posted a video a couple days ago actually. It was about me selling Wells Fargo because I didn't like where the company was at, where the business model was at. And as you can see here, I replaced it with a 1% increase in Caterpillar stock. Where is it? Right here. And then I also added Honeywell at 2%, which is right here. And then Starbucks is 2% as well. We're actually up about 2% on that. So with Starbucks, here's my theory around Starbucks. Now, first off, I talked about in that video where I was talking about where I dropped Wells Fargo and added Starbucks. The fad is bad, but the trend is your friend. The fad is a short-term influx where I used the example in the last video of a dead meme, where a meme explodes for a couple of weeks or a month, and then after a month or two passes, it dies out and no one ever thinks about it ever again. That's a fad. A trend is a long-term trend where people get more and more of it every single year. Coffee, especially Starbucks coffee, is a perfect example of that. This is just the last 4 years. They've been a very high growth company for pretty much the last decade or so now. But let's look at the last 4 years. 12 billion worth of gross profit, 15 billion worth of gross profit, 16.7, and now they're up almost to 18 billion worth of gross profit. So as you see here, 12.8 versus 17, almost 18 billion. That is about a 40-50% increase in gross profit over the last 4 years, which is very substantial. And this is a company that has a pretty good stack of cash in it. I was talking about 1.5 billion, pretty good relative to their size, to their market cap. When we look at Starbucks, for example, we search their ticker right here and pull it back up. Starbucks market cap sits right at 90 billion, so they are a little bit bigger than Ross, but they do have a cash position that's exactly almost double that of Ross. They have 2.68 billion, and they have increased that cash position from 3-4 years ago. And this is a company, I think, with its growing revenues, and I think in the environment we're in with the shutdown, I think that they will do just fine. As you can see here, over the last 5 years, I showed their growing revenue. Their growing dividend is very good as well. So when I talked about Ross, their growing dividend that was pretty massive in growth, Starbucks is a very similar scenario. So they have 16 cents worth of dividends, and then they increased it to 20, to 25, to 30, 36. That's a 20% increase. And then they increased it up to 41 now, and they're due for another dividend raise in about 4 or 5 months. And they have a dividend yield that is almost exactly 2%. They have a $90 billion market cap on a 27 PE ratio. Starbucks, in my opinion, is very much going to not only survive but thrive in this environment as well. And here's my couple of reasons I have behind this. Here's my bullish thesis. So those of you that don't know about Starbucks, I want to give 2 basic points. The first one is very common that everyone knows. First off, they have a huge dominant app that dominates the coffee market. They have a Starbucks reward systems where you order X amount of coffees and then you get free coffees as well. So you bring that apart as your daily routine. You can add debit and credit cards into the app so it makes it easy and convenient, as well as things like curbside pickup, pickup at the counter, pickup at the drive-thru. They make it as quick and fast, as easy as possible. And with those reward systems, they keep on bringing people back for more, back for more. And another thing, the same thing goes with the reward systems with the app. Obviously, caffeine is a huge addictive drug. It's the most popular drug in the world. Everybody gets addicted to caffeine. I'm addicted to it as well. And I'm sure a lot of you are addicted to Starbucks as well. And the second reasons why I love Starbucks in this environment, in this scenario. So we saw how hard the stock got hit. It was about exactly $100. And even today, you're buying it at a 22% discount from its high right here in 2019. And considering that it dropped all the way down to $56 a share just a couple months ago during the March lows, I think it was absolutely overdone in my opinion. People were worried about the shutdowns in China with the coffee shops. Most of their revenue primarily comes from America, but the growth story here for Starbucks is still in the international markets. Those of you that don't know, which I was thinking about covering in one of my videos, Luckin Coffee. Luckin Coffee, I hate this company with a passion. They're down 86% now. This was a stock that everybody was so hyped up about. I hated it. There were so many things I didn't like about it. I'm not going to get into that because we're talking about Starbucks. But its number one competitor in the foreign market, specifically China, was Luckin Coffee. Luckin Coffee, there's no telling what's about to happen. They're about to be in a whole world of hurt. There's potential fraud there. There's tons of financial issues. Luckin Coffee is not going to be the business that nobody thought that it would ever be. So the same thing goes with Starbucks. Starbucks is going to be the one to take over that dominant position over Luckin Coffee. So I think Starbucks, as we get more into the third and fourth quarter, those of you that don't know, for most companies, when they make the most revenue, when they make the most profits, is in the third and in the fourth quarter. So for Starbucks, that is definitely no exception. For Starbucks, that is definitely the truth. When they start releasing their drinks, such as their pumpkin spice and their seasonal drinks that are only available in the last couple months of the year, that is when sales explode. Furthermore, regardless as to whether or not they have their seasonal drinks or not, when weather is cold, that's when people want to buy coffee. When it's 100 degrees outside, 101 degrees outside on a nice hot summer day, people don't want to grab a hot cup of coffee. Who wants to do that? People want to drink things like iced teas and snow cones, and they want to have things that can cool them off. The same thing goes for the winter. When it's super cold outside, when it's below zero, when it's freezing, when there's snow, when there's black ice out on your driveway, Starbucks is where you want to be. It's the hot cup of coffee that you want to have warm you up from all that cold weather outside. So that makes sales drive up through the roof. So the shutdown has been through the first half or so of the year, the first couple of months. Now, who knows if it'll end next week? Who knows if it'll end 3 months from now? But we do know that it will end within the next couple of months. So let's say that it extended way far out. Let's say it ended in, say, September, several months from now. I doubt that's realistic, but let's say that it did. You would have all of the primary profit puffy months for Starbucks in the green, selling their coffee right back to normal. People would be buying Starbucks right during its peak times of the year, and Starbucks would reap the rewards from that. And also their China markets and their other international markets would be open for business as well. And I think Starbucks is in a perfect position to bounce back. Everybody likes to talk about the V-shaped recovery for the stock market. You see here it's followed a pretty similar pattern compared to the S&P 500. I think who knows what's going to happen with the S&P 500. We might have a V shape. It might go back to all-time highs. It might go back down. It might hit new lows. But I think strictly for Starbucks, just for Starbucks, when we get back into the fourth quarter and they start reporting those big numbers towards the end of the year, I'm seeing all-time highs. When we get back to the beginning of 2021, I think we're going to see new all-time highs. This is going to break $100 a share, and I'll be the one to capitalize off of that, as well as the massive dividend growth upon this and the 2% yield. So the third company that we're going to be going over here is ticker symbol AWK, or American Water Works Company Incorporated. They're a $121 stock, a $21.8 billion market cap, a 34.5 PE ratio, and a dividend yield of about 1.7%. And let's look at the dividend growth here. So there's a reason I wanted to point out this company, and it is very similar as far as the performance and the type of stock it is. It is very similar to the Ross type, the Costco type. And I wanted to point out these two stocks, AWK and ROST, Ross and American Water, because when I was making that video for Wells Fargo, replacing it with new stocks, these were two of the main stocks I considered. I just want a little bit higher yield while we're in a downturn. But this stock yields 1.7%. 5 years ago, they paid 34 cents a year in dividends. They paid 38 a quarter in dividends. The next time, 42 to 46, up to 50, and now they just increased it another 10%. Now they're up to 55 cents a quarter in dividends, and that is massive growth. From 34 up to 55, getting close to double that in just a 5-year span, that is huge. And speaking of massive dividend growth, let's look at the massive share price growth. That's crazy. 125% for a water company. This is such a need-based business. You know, one of the utility companies that I like to talk about a lot, which is a very need-based company, I have Southern Company in my portfolio. It is one of the largest holdings in my portfolio. If you can see here, it's went up 25% over the last 5 years. They've went dividends from 54 up to 64, so not as good. But with utilities, there is a need base for utilities in the sense that electricity, people are always going to pay their electricity. It is more of a last resort type of deal. People need their lights on. They need to pay their bills in time. But when it comes to water, when it comes to AWK, this is not a choice. If you came to the point where you lost your job, you don't have any government assistance, and you literally have to choose between eating or paying your bills, you're obviously going to choose to eat. That is happening in a lot of big urban areas right now. And the same thing goes for your water. If you have to choose between paying your water bill and between paying your electricity bill, you're going to pay the water bill if it got to that point. You need water to survive. It's a necessity. There's no way around it. Food and water is the basic primary drives for survival. You can't avoid it. So the same thing goes for American Water Company, AWK. This is government regulated. They have just very slow, steady increase in profits. Every single year, the government tells them how much money they're allowed to make, and they increase that just a little bit every single year. This hedge here with a 1.7% dividend yield, that'll make sure that your money is matching inflation as well as the increase in dividends, and the share price is going up very good as well. The one reason why I didn't add this to my portfolio yet, the key word there is yet, because I probably will be adding it to my portfolio, is that it hasn't really been hit at all in share price, and I do think it is a little bit high in price. I would like to see it closer to $100 a share. The fact that it's went up in 5 years in pretty much a straight line, and it does have a high PE ratio, I am going to wait until it goes down a little bit more. And the reason why it has such a high PE ratio is because the people on Wall Street know the exact same thing that I'm saying. They know that this is a safe, stable dividend company, and they're willing to invest in it because they know they're pretty much guaranteed returns almost no matter what. So that's why a company like this has not been hit hard at all. If we can get it back down to $100 a share, or God forbid, even below $100 a share especially, I would definitely be a buyer, and I would be buying this in a heartbeat. I'd like to see that dividend yield probably closer to 2.5%, maybe even closer to 3%, and I'd be buying it like wildfire. If we see here over the last several years, we can see it is just a slow, steady, gradual increase. This is a very boring business model. That's great. I love the boring business models that don't change and get me steady profits. 1.8 billion to 1.98 to 1.96, about steady that year, and now they're up to 2. It is just a very slow, steady increase, and it is going to continue through this recession, and I'm potentially looking at adding it to my portfolio. And then the last stock that we're going to be going over is ticker symbol MO, or Altria Group. And the reason why I wanted to include this, you know, with a lot of people that has their stock picking videos, they like to pick a lot of the same names. They say, okay, we're going to look over Facebook stock. Okay, and that's a big tech company. Now we're going to look at Apple stock. Here's why you should buy Apple stock. And then they'll go over Microsoft, and then they'll go over Google. And it's a lot of the same names over and over and over. And it's not that these names are not great companies. Even buying Alphabet, Google, at $1,400, it's never a bad buy. If you're buying it at $2,000 a share, it's still a good buy. Same thing for companies like Amazon and stuff like that. But with MO, I like to cover all four of these stocks that are stocks that people typically don't cover. And with this stock, this is by far the most speculative out of the group. I would say out of the other three that I just covered, they're not really speculative at all. They're all very profitable. They're very successful companies. This is a profitable company, but I want to talk about some of the performance issues that they've had over the last recent years. Now, first off, this is a company that I own. Of the four stocks that I covered, two of them I own. Starbucks, I was telling you I just added, and Altria makes up about 2% of my portfolio. It is by far the highest yield in my portfolio. Now, one thing that I want to talk about here is not the share price gains. I don't care about talking about the future in the coming years. I'm not really too focused on share price gains with this one, as I am not really with most of my stocks. It has a dividend yield that is almost 9%. And a couple days ago, when it was down, just a couple days ago, when it was here around $35, it was actually closer to 10%. This is a stock that has almost a double digit yield, but is still pretty safe. Considering the dividend yield, how high it is probably the safest stock in the stock market, in my opinion, for an 8.89% dividend yield. As you can see here, the dividend has went from 52 to 57 to 61 to 66 to 70 to 80, and now they're up to 84, and they're due for another dividend raise in just a couple months. One thing that I think is really important about Altria that I wanted to point out here is that they recently had a quarterly earnings report. And the one thing that I was really on the fence about with Altria, I was trying to decide if I wanted to increase or decrease my position with Altria because it does have such a high yield. Because on one hand, I do think they're able to maintain it, so that really makes me want to increase my position and take advantage of this ginormous yield. On the other hand, naturally, I don't want to get caught up in seeing that number, and I don't want to see that red flag and buy into it heavier, and then they cut their dividends, so it definitely has some risk here. But there was one thing that the CEO just came out and said just about 2 weeks ago from the time I'm filming this. The CEO said that they were fully committed to keeping that dividend. They understand that the shareholders own this stock for the dividend, just like I do, and they're fully intending on keeping it. So one of the reasons over the last 5 years why this stock has been hit so hard, even in a bull market before this recession ever hit, is that they had a position in Juul that went very, very wrong. They lost billions of dollars off of Juul, but they do have a lot of other smokeless tobacco products, and they also have a category in cigars that is doing very well. They're a very profitable company, and then those people that do smoke are very, very sticky customers like Marlboro and Camels and stuff like that. People buy those same brand of cigarettes for years and usually even decades, and some of them even smoke it for a lifetime, 50, 60 years going in and out. And Altria is the one to profit from that. They also have another company, Philip Morris, that is very similar to MO Altria Group. And Altria Group, in my opinion, if I had to bet one way or the other, I think with the recent raise of capital that they had, I think they'll be able to keep their dividend. They have been able to keep their dividend for over 50 plus years now. They did keep it during the Great Recession. I think they'll be able to do it if I had to bet one way or the other. I'm not increasing my position for now. I want to see how the company does over the next couple of months. But if you're looking for a more speculative play, a potential to get a huge dividend yield and get some decent growth over the next couple of years when the stock does eventually recover, a lot of the bad news has already been priced in, and I think over the next couple of years, the share price will increase quite dramatically. We'll get back into the 60s, 70s, 80s, whatever, and this will probably double in share price over the next couple of years when we get back to normal. But meanwhile, you'll be getting paid an 8, 9, 10% dividend yield in the meantime if they're able to keep it. So if you want a more speculative play there you go. There's Altria Group. And those are the four stocks that we went over. Those of you that made it to the end, thank you guys so much for watching. We're going to give you a quick update on my portfolio. For starters, let's look at the biggest winners and losers. I wanted to point this out here. Foot Locker has skyrocketed today, up like 6% or something like that. We are now up 54.26% on Foot Locker, and we're up almost 50% again on Whirlpool, 42% on Discover, 33% on Home Depot. So many of my stocks are doing so well. I'm so glad. I'm so happy. I do wish that they would go down, though, in my opinion. I do want to see my dividend yield get back up. I don't really care so much about the market gain. I know you guys watching like to see this number go higher and higher and see me hit all-time highs. That's not what I care about. I'll care about the market gains, the share price gains when I'm old, when I'm planning on selling these stocks. Because if I'm not selling these stocks, which I'm not, then there's no reason for me to care about the market gain. I care about the earned dividends. That's why we updated these numbers right here. We're talking about my annual dividend income increasing every month. There's my monthly dividend income there, and there's my portfolio value. My monthly dividend income is what I care about. I don't really care so much about this number. It's nice to see it go up, so if I ever needed it, it's there, but that's not what I'm focused on. The biggest losers in the portfolio, or the only two losers that we have in the portfolio, were down 1.15% or 40 cents on Verizon Communications. Procter & Gamble were down 2.2% or about $1.17. But overall, the portfolio is doing very well, and a lot of my top holdings were in the green on, and Visa were now up 24% for one of my top stocks. In total for the portfolio, we are up $226.69, or about 13.63% gain, and we are in the green again as well today, or about 2.1%. And for activity, we did just receive one more dividend. We did receive a 48-cent dividend from Caterpillar stock, and we did just have a couple other stocks claim their dividend. I know Microsoft and Discover Financial Services, we had claimed their dividend as well. And those of you guys that made it to end, first off, thank you guys so much again. If we go here to the cash movements, the $90 I received from our referral bonuses. I'm speechless. I don't have ads for my channel. I can't make money from these videos unless you guys have some kind of things with the referral bonuses. I've considered making like a Patreon, for example, where you guys have a section where you guys chat to each other in the Discord and we talk stocks and stuff like that. But I probably wouldn't want to offer that until I get some more subscribers and where there's enough of a compelling experience to where multiple of you guys are in it and where it actually provides some value to you guys that are interested in the Patreon. But you 9 that did use this referral link, thank you guys so much. Those of you that watch the end, make sure to use this link if you haven't used it already. It's in the description of all of my videos. Make sure to leave me a comment down in the comment section what you thought about this video, what you thought about the 4 stocks that I picked. I'll see you guys next time.